All right, let's talk about something wild. Imagine a single day where trillions of dollars are zipping around the planet in an absolute panic. You'd think that would lead to a crash, right? Well, in April 2025, the biggest market in the world had a massive, full-blown panic attack, and yet it didn't break. Today, we're diving into the hidden story of how the system survived. So let's just start with a number that is, honestly, it's hard to even process. $9.5 trillion. That's not the total, that was the average daily trading volume in the global foreign exchange market back in April 2025. This is the financial circulatory system for the entire planet, and on this day, it was pumping like never before. So, how do you even wrap your head around a number that big? Let's try to put it into perspective. This one market, trading currencies, is 30 times larger than the entire world's daily economic output. 30 times. Everything we all produce, build, and sell in a day, the FX market just completely dwarfs it. Which, of course, brings us to the big question here. What in the world happens when a system that massive, that fundamental to everything, suddenly gets hit by a shock and has a complete panic attack? Well, let's find out. Okay, so to understand what happened, we need to set the stage. And our story really begins with something that sounds, kind of boring, but is absolutely critical: rising interest rates. This is what made the market so fragile in the first place. So here's the deal. For a couple of years leading up to this whole event, central banks all over the world were jacking up interest rates, trying to fight inflation. As you can see on this timeline, by 2023 and into 2024, the cost of, well, pretty much everything, including protecting your investments, had gotten really, really high. And that brings us to this key idea: hedging. Honestly, the easiest way to think about it is like insurance. If you're a huge pension fund in, say, Japan, and you own billions in US stocks, you're always worried the dollar might fall and just erase your profits. So you buy an insurance policy to protect yourself. That's hedging. Well, what happened was that insurance suddenly got crazy expensive. Because of those interest rate hikes, the cost to hedge the US dollar against the euro, for example, just shot up from under 1% to over 3.5% in less than a year. All of a sudden, that vital protection was costing a fortune. And what do you do when your insurance premium goes through the roof? Well, a lot of these huge investors did exactly what you might expect. They started canceling their policies. Big players like Japanese life insurers cut their hedging way back from around 60% down to 40%. They were basically gambling, leaving trillions of dollars just out there, exposed. So now the stage is set, right? You've got this massive, underinsured market. And then, in April 2025, the trigger gets pulled, and it shattered a rule that everyone in finance thought was written in stone. And the trigger was this: unexpected news about new US trade tariffs. It wasn't just any old news. It was the shock of it, the uncertainty that sent this wave through the entire system. It forced everyone, everywhere, to rethink their investments, like right now. For decades, there was this golden rule in the markets called the dollar smile. And it's a pretty simple idea. When things get scary and chaotic around the world, investors panic and they all rush to buy US dollars for safety. It's always been the ultimate financial safe haven. But this time, the unthinkable happened. The rule just broke. As you can see right here, market stress shot up, just like it was supposed to. But instead of smiling, the dollar frowned. Its value actually started to fall. The safe haven wasn't safe anymore. And this quote just nails the feeling at that moment. Think about it. For all those big investors who had dropped their insurance, their backup plan, the idea that the strong dollar would save them in a crisis, it just evaporated. They were completely naked in the storm, and they had to scramble for cover. So what does that scramble actually look like on a global scale? It's chaos. It's a mad dash for the exits. And to really get it, we've got to look under the hood at the market's hidden plumbing to see where all that money was flowing. Okay, so first, a super quick overview. The foreign exchange market isn't just one thing. It's made up of different parts. As you can see, the biggest hunks are things like FX swaps and spot trading. But the ones you really need to pay attention to for this story are the smaller pieces: forwards and options. Because this is where the explosion happened. When all those investors were desperately trying to buy back the insurance they'd gotten rid of, they flooded into these specific tools. I mean, look at these numbers.
Trading in options more than doubled. Forwards and spot trading went through the roof. This was a surgical strike of panic.
But here's the really interesting part. What about the biggest slice of the market, those FX swaps? It barely moved, grew by only 6%. That tells us something really important. This wasn't just random, blind panic across the board. It was laser-focused on one thing, managing this new, unexpected risk. And that brings us to the real mystery at the heart of this whole thing. We're talking about an extra $1.5 trillion in panic-driven trades hitting the market every single day. That is a fire hose of sell orders. So how on earth did the system not just completely crash and burn? Well, the answer is a term that sounds kind of technical, but is actually pretty simple: dealer internalization. This was the secret weapon. Think of a huge bank like a clearinghouse. They have one massive client that needs to sell $1 billion, and at the exact same time, another client needs to buy $1 billion. Instead of sending those orders out into the wild, the bank just matches them up internally on its own books. So how much of this frantic trading was handled in-house? This number is just staggering. More than 80%. The big banks managed to absorb over 80% of that panic internally. It was like a giant invisible cushion that the rest of the market never even felt. So, okay, we've seen the panic, the broken rule, the hidden savior. What's the big takeaway? What does this crazy near-disaster day tell us about the financial world we all live in? Well, there are a few really big lessons here. First, we learn the market has these incredibly powerful but hidden shock absorbers. This whole internalization thing acted as a critical firewall that stopped the crisis from going nuclear. It shows just how much we rely on this, this invisible plumbing. But, and this is the big but, it also showed us how preconditions, like everyone being underinsured, can pour gasoline on the fire when a shock finally hits. The official report on the event really summed it up perfectly. Instead of causing the crisis, the FX market, the biggest market in the world, actually ended up acting like a giant shock absorber. It bent, but it didn't break. And that's where we're left, with this kind of unsettling question, right? The hidden plumbing, the secret safety nets, they held up this time. But the event also exposed a massive vulnerability just beneath the surface. The system bent, but it came pretty close to breaking. And it just makes you wonder, what happens when the next shock comes along? And what if it's even bigger?